Hi, I'm Jim Jackson, and I'm bonding over bonds with my colleague, Kevin Kaase. So you may recall that the last time we bonded over bonds, on video at least, the market environment was fairly tranquil. A lot has changed since then, most notably a decline in interest rates.
Yeah, no doubt. I mean, that was quite dramatic. I mean, it definitely humbled a lot of pundits out there. Seriously, though, who would have thought that we would have rallied into a 112% yield on the 10-year Treasury? That happened on July 20th. I didn't expect that. I thought we'd see 2% before we saw 1%.
Sure. I mean, basically what you're saying, Kevin, is that interest rate forecasters are as credible as Jeff Bezos in a cowboy hat.
In Texas, we have a saying for that: all hat, no cattle.
Sure we do. Sure we do. So, Kevin, this move in rates really reveals that forecasting interest rates is a dangerous business.
It really is. It's been really interesting to me just to, we've been so concerned with the Fed and inflation, and then all of a sudden we have this shift to we're just concerned with the Delta variant and its impact on global growth or economic growth, if you will. It just shows you how fast things change in the marketplace.
Sure. I mean, I think what we're trying to see is that stock and bond markets are trying to price in a greater level of uncertainty regarding future economic growth, and we started to see the stock and bond markets diverge in that respect.
We really have. I mean, it's credit spreads have definitely traded off their tights. Equities have sold off from their highs. However, as you saw yesterday, the market has rallied back really hard. But I think the point that you need to be aware of is the volatility is really increasing at this time, and that's basically because of the uncertainty surrounding the Delta variant, if you will. I think volatility is here to stay for the near term, and as you know, the market does not like uncertainty.
Yes, but I think we should be clear that we're not expecting a market dislocation like we saw in March of 2020. So I think there's a few takeaways. One is that a key part of our outlook for the second half is we think there's an opportunity for active credit to outperform. We think that still holds. But we also think it's important for investors not to react to the day-to-day movements in the market and to focus on their risk tolerance and their long-term asset allocation. So thank you, Kevin, and thank you for bonding with us over bonds.